Welcome back to FutureVest. If you're new to investing, chances are you've already faced some challenges, or maybe you're worried about making mistakes. And look, everyone makes mistakes when they first start out. I know I did. Which brings us to today's video. Today, we're uncovering the biggest pitfalls new investors fall into, and most importantly, how to avoid them. Stick around because at the end, I'll reveal the one mistake even experienced investors regret. One of the biggest mistakes new investors make is letting emotions dictate their decisions. We've all been there. You see a stock skyrocketing, everyone is talking about it, and you just don't want to miss out. This fear of missing out, or FOMO, can push people to buy stocks at their peak, only to face losses when the hype dies down. Remember what happened in 2021? A ton of people jumped into speculative stocks during the meme stock craze, thinking they were going to get rich quick, only to see their investments plummet. And I get it. When everyone on social media seems to be getting rich quick, it's hard not to feel like you're missing out. But trust me, avoiding FOMO is crucial. The key here is to stick to your plan and invest based on thorough research, not fleeting emotions. Don't let yourself get caught up in the hype. Another common mistake is putting all your money into one or two stocks. Look, I get it. You find a company you're really excited about, maybe you're even using their product right now, and it feels tempting to go all in on a sure thing. But let me tell you, this is incredibly risky. Diversification, my friends, is your best defense against the unpredictable nature of the market. Think of it like this. Instead of holding only tech stocks, which might be doing great right now but could easily take a downturn, consider adding some ETFs to your portfolio. ETFs, or exchange-traded funds, allow you to invest in a basket of assets, like bonds, real estate, or even international markets. This way, even if one sector of the market isn't doing well, your entire portfolio won't be decimated. Remember, diversification is key to weathering those inevitable market storms. Want to avoid these mistakes? Try Wealthsimple. Speaking of making investing simple, Wealthsimple is an excellent platform for Canadians to avoid common mistakes like poor diversification. Personally, I think Wealthsimple is a fantastic option for new investors. They offer these things called automated portfolios, which basically take the guesswork out of investing. They'll ask you about your risk tolerance and financial goals, and then create a diversified portfolio designed specifically for you. And if you're worried about those pesky tax implications, don't be. Wealthsimple also offers TFSAs, or tax-free savings accounts, which let your investments grow tax-free. This isn't a sponsored video or anything, I just genuinely believe in their product. In fact, I use them myself. If you're interested in getting started with Wealthsimple, you can check out my referral link in the description down below. It's a great way to start investing smarter today. Another grave mistake: ignoring fees. Those small numbers can cost you big time. Okay, let's talk about something that might seem boring but is super important: fees. Many new investors overlook the impact of fees, but let me tell you, even small charges can eat into your returns over time. For example, let's say you invest in a mutual fund with a 2% management expense ratio, or MER. Seems small, right? But over 20 or 30 years, that 2% can add up to thousands of dollars in fees. That's money that could have been growing in your pocket. Instead of sticking with those high-fee funds, look for low-cost options like ETFs or robo-advisors with lower expense ratios. Remember, every dollar you save on fees is a dollar that stays invested and working hard for you. The biggest mistake new investors make: it's not what you think. So far, we've covered some major investing mistakes: letting your emotions get the best of you, not diversifying your investments, and ignoring those pesky fees. But there's one mistake that stands above the rest. It's something that stopped countless people from reaching their financial goals, and I'll reveal what it is in just a moment. But first, let me ask you a question. How many times have you put off investing, telling yourself I'll start next month or I need to do more research first? If you're anything like I was when I first started out, the answer is probably too many times. The biggest mistake? Not starting early, it's that simple. Time is your most valuable asset in investing, even more so than the money itself. The longer you wait, the harder it is to catch up. For example, if you start investing just $100 a month at 25, you could have over $250,000 by retirement, assuming a 7% return. But if you wait until you're 35 to start investing that same $100 a month, you'll only have around half that amount by retirement. That's the power of compound interest. Don't let fear or hesitation hold you back. Start today, even if it's with a small amount. Investing is a journey, and avoiding these common mistakes can make all the difference. What's the biggest lesson you've learned as an investor? Share in the comments. Don't forget to like, subscribe, and hit the bell icon for more FutureVest insights.